So short-term pressure is real. It's a real problem right now. I have to say, we have a really strong market because we have job growth in our market. And you're thinking when the market resets next year, you think you're going to go right back up to the $2,000 mark. Hello and welcome. My name is Gino Barbaro, one of the co-founders of Jake and Gino. And in this how-to video for this week, we're going to be talking about rents softening, the future of multifamily, and is there oversupply? I know I've touched on this a few weeks ago, but we've got new data out. And let me start out by saying, I don't want to sound like a conspiracy theorist, but all of this data coming out, can we trust it? Or do you go with your gut in multifamily and in real estate and as an investor? Unfortunately, if you go with your gut, sometimes the gut misleads you or takes you down the wrong path. You need to have some type of data. But what's interesting, if you are investing in real estate and in multifamily and you are in the market, you're on the ground. You're seeing what's going on right now. I don't need a report to tell me that rents are softening. I understand in my market of Knoxville, Tennessee, right now, rents are softening. Why? Logically, we have an oversupply of even high-end units. And it's not just the high-end units coming on, it's the amount of high-end units coming on all at the same time because there was an overabundance of building. COVID slowed things down. There was still cheap money throughout COVID. Permits took a little bit longer. Labor was harder to get. But now all of a sudden, over the last 18 months, in a lot of markets, they've had a lot of oversupply. And I'm just frustrated with a lot of this data because as I've been saying to my business partner, Jake, and to anyone who wants to hear me, we, in my opinion, have been in a recession for the last 18 months. It feels stagnant, but they're out there screaming from the rooftops, we have great job growth. Inflation, we got a lot of inflation. We can't drop rates, right? That's what they've been saying. So why would they be saying that? Is it really political? Well, in my opinion, once again, I think it's political. All of a sudden, they've wiped out a million jobs. So right now, we have basically almost zero job growth. Well, I think 19,000 jobs were created in August when we thought hundreds of thousands of jobs. What they're saying, and I read a report, that through Biden's 4 years in office, they only created 900,000 jobs. That's even with all the people coming back from COVID. Now that is an abysmal number. I don't know how they couldn't have gotten it wrong without being completely incompetent. They can't be that incompetent. I think they basically held the numbers quiet because during, the run up and during the election period, everyone thought it was great. But we out there, we in the business world, we were getting a paycheck, knew it wasn't great. We knew it sucked. So I'm going to put interest rates on the side. I'm going to put inflation on the side. We're going to talk specifically about what's going on in the market right now. I've got some numbers that I want to share with you. So I'm going to be looking down at my notes because I really want to make sure that these numbers are accurate. In August of 2025, the national median rent dropped to about $1,400. That's the steepest decline since 2023. And we can tell you right now in our market, rents are flat. The once burgeoning Knoxville market, rents were going up 10, 15, 20%. And it's incredible what happens when the market slows down and you've got a lot of oversupply. And it's, I think, going to continue because what's interesting is we're going to be touching on concessions in a second. But last year alone, more than 600,000 new apartments came online, with another 243,000 delivered in the first half of this year. You're talking almost a million units coming online. That's insane. That's incredible, the amount, right? So with all that happening, vacancy rates have gone up to 7.1%. That's the biggest and the highest level since 2017. And we feel that. We see with our physical occupancy as well as our economic occupancy, it's ticked down. So you need to be proactive. If you're running a business right now, what you need to do is you need to be dropping rents. And that's interesting. Why isn't inflation crazy like they thought it would be? It's because housing is such a big component of it. If rents aren't going up 10%, but they're actually staying flat, and in some markets, they're literally going down, we know inflation is not a problem right now. As in, we knew 4 years ago that inflation was not transitory when they should have dropped rates back in 2022. If you're going back into history, that was the big lesson. They waited too long, then they raised them too high, and they shocked the system, and that's where we are right now. So let's go into really some other numbers that I think it's incredible. I got my paper here because I was looking at rent concessions. On the top 20 markets for rent concessions, Florida has 10 of them. The top 4 are Florida. The 5th one is Austin. The 6th one is Nashville. That's incredible. And Orlando lands at 20. And we're talking on the top one for, I think the top one was Naples. It has like 7 weeks of rent concessions. So you're giving away almost 2 months free rent today. So you think you're getting $2,000 a month, but you're really giving that $2,000 away for free. So you're really only collecting $20,000 for a whole year's worth of rent. So that drops it down to what? $1,800. So you're way below whatever the market is. And you're thinking when the market resets next year, you think you're gonna go right back up to the $2,000 mark. I don't think that's happening. So it's very interesting. If you're underwriting right now, beware of brokers telling you, oh, you can raise rents. I think rents are going to stay flat. Now, if you're buying a value add and you know the rents are $1,300 and you know the market is around $1,600 or $1,700, that's obvious. But if you're buying a new build right now, really dive into the concessions part, dive into the vacancy part, and you need to underwrite for that vacancy. In a lot of markets right now, occupancy is at 90%. So you have a 10% vacancy in that market. And that may just be physical vacancy. Dive into the economic vacancy, right? Heads and beds is one thing, that's physical. What's going on economically? Who's paying? And I'll guarantee you, even those who are running their properties really well, remember the buy right, the finance right, the manage right, that portion where you're actually running the properties, you're still gonna be a couple points below whatever physical occupancy is. So if you're at 92 with physical, you're probably at 90% for economic. I'm getting a little worked up here, because I just don't like to see what's going on, what's unfolding, what's transpiring with these numbers. Can we actually even trust the data that I've said? I think that we can, from my opinion, once again, because I feel it. This is what's been happening over the last 3 or 4 or 5 months, and that it's been unraveling in our market. And I have to say, we have a really strong market because we have job growth in our market. We do. We have jobs coming in. We have companies coming in, and we still have population coming in. Beware, if you're in a market where people are fleeing and you're getting a lot of units being delivered, that's an issue. Now, fortunately, for a lot of these markets that I talk about with concessions in Florida, in Austin, Texas, in Nashville, Nashville is a really weird market because it is exploding, the city. I read a stat a couple weeks ago. I think 40% of all the multifamily in Nashville has been built since 2014. So you have such an influx of new builds. The problem, well, it's actually the opportunity with Nashville, but the problem is that there is so much supply coming online, but there is so much demand as well because jobs are coming in by the boatload there. Their airport is a very good barometer. They've got Southwest Airlines. It's a really great hub. It's an amazing place to have a business convention. You have a lot of people going there for events. Nashville is what Jake and I call, really, it's the East Vegas. If you're going to Vegas and you don't want to fly out to Vegas in Nevada and you're on the East Coast, you go to Nashville. We've done a couple events there. It's a great city. They're building also a stadium across the river there, right next to downtown. It's just insane what's going on. Now, what does that mean if you're an investor right now? There's the problem. We have short-term pressure. Right now, it's difficult. The deals are not there. Interest rates are still high. Sellers are like, if I don't have to sell, I'm not going to sell. But I'm going to throw this property out there. I'm going to put this price, and we'll see what the broker can do for me. They're not budging. Buyers understand that they can't pay the prices they did 2 and 3 years ago because the cost of capital is higher. You're going to have to come up with much more of a down payment, which dilutes your returns. And oh, by the way, the banks are being more difficult. And it's interesting because expenses are going up. We just got a report right now from our insurance companies that Fannie and Freddie are looking for exposure. They want more. They want you to cover more stuff under their policies. Now go in there and just Google Fannie Freddie, what they're looking for. I think they're looking for coverage on properties. I think it's exposed to, I don't remember the exact verbiage, but sexual battery, any kind of violence on the property. They're looking for operators to put additional coverage on their properties, which means insurance is going to go up. That's the problem. Property taxes have gone up. Insurance seems like it wants to go up. As soon as we got some good news with insurance rates are starting to stabilize. Fannie comes up with this and says, hey, I'm going to make it a little bit more difficult. They're very stringent. They're going to go through all these properties, and a lot of these properties right now that are being sold are older properties. They're going to want a lot of these capital expenditures taken care of. So the seller who wants $17 million for the property and you've got to do $2 million in CapEx, 3 years ago, you could have floated it. Now you can't. So short-term pressure is real. It's a real problem right now with a lot of these markets, because even though you got these properties and you're going to get this concession burn off and these properties are going to be filled, you still have that when you're drinking and you're having a party at night, you're having a great time, all of a sudden you get hammered, have a few beers, you wake up the next morning, you have the hangover. That's what's going to happen, in my opinion, with concessions 6 months from now or 8 months from now. They're going to burn off. There's going to be a hangover effect. You can't just go back to market with your properties. You're going to have to go from, like I said, if it's a $2,000 mark and you're in theory are giving it to them for $1,800 because you gave it to them for free, you can't go to $2,100. It's not happening. It's not going to happen. You may go up 5%, which may take you to $1,850 or $1,900. But once again, this is the second problem, that what it means for investors. The second part is just as important, having the discipline to be able to underwrite that, understanding that if you're going into a property and you're looking at it, you need to tell the broker or the seller, yeah, you have all this concession on the books. I'm going to do an actual budget and an actual T12 based on where rents are. I'm going to underwrite these 20 or 30 units at $1,800, not at $2,000, at $1,800. And then I'm going to do my pro forma based on a 3 or 4% rent increase based on that. Now that's going to be difficult to sell because you're not going to be able to close deals. You're just not going to. But my mantra and what Jake and I preach, no deal is better than a bad deal. Now I can go on and speak to you for the next 3 hours, do 6 shows on how many deals I've done. Without Jake, this is before I met Jake, I did 3 or 4 deals that I should have never done. I thought they were great. I didn't understand. I didn't have the discipline or the awareness to focus on buy right, manage right, finance right. Now, if you're looking to figure this all out, AI is a great tool. But what I've learned is if I've got a coach by my side and I've got somebody that I can talk to that's done the deal. I had a guy named Marco yesterday. He's part of the Wheelbarrow Profits community. He called me up 3 different times. He's trying to put an LOI in. Great. AI can help you put the LOI together. But is AI going to help you with all of the nuances? Is AI going to help you once you talk to the broker? What should you say to the broker? How do you frame things? What questions to ask? Getting feedback. That's the difference. If you want to learn how to become a multifamily investor, just go to wheelbarrowprofits.com, schedule a call with one of the team members, and I'm telling you, if you're looking to get into this business long term, that's what I would do. That's what I did back in 2008. I just got fed up making mistakes. I went out and I got 2 different mentors. I spent a ton of money on my investing education. But fortunately, when Jake showed up, who knew nothing about multifamily but had the desire, I had the experience and I had the knowledge. He had the desire. You put those 2 together, bro, it is like gasoline on the fire. So there's one more thing that I want to really touch on before we take a break. What's in it for the investors also? It's market selection. Just be aware of what market you're looking at. Be aware of how many permits are in the pipeline, because permits have dropped dramatically over the last 12 months because builders are not going to build with the cost of capital the way it is. And it's one thing, if there's no permits right now, once this supply burns off, there's still going to be demand. But it's going to take 12 to 24 months for these permits to come through and you get shovels in the ground. So you're seeing what's happening is a seesaw effect where you've got a ton of units coming on. Then they stop and they wait 12 months and then they come back on. So you're going to see 25 and 26 where a lot of this burn off is going on. But for the long-term opportunity, it's going to be amazing. So what I'd like to say is understand your market, the specific market that you're in. You may be having a supply crisis right now where you're seeing markets like Dallas. You're seeing markets like Austin. You're seeing markets like Nashville, as I'd mentioned, markets like, Miami, Naples, Florida, Sarasota. They've got a lot of supply coming on. Once that burns off, there's still people moving there. Going back to that first thing for investors, understanding the discipline to be able to underwrite diligently and to understand that it's okay to pass in a deal. I think that's the important thing. But if you can find a deal that you like that pencils out and you have the ability to bring the capital, I think now's the time to strike, because now is the time where a lot of investors are starting to exit. It's been a good 18 to 24 months where a lot of investors haven't done deals that just haven't made sense. And sometimes at one point, you got your pencil, you put your pencil down and you leave the business for good. It's one of those things that multifamily, and I think real estate in general, when you get bored, there's a lot of investors out there that get bored. They just quit. They just leave. They go to something different like crypto, or they go something like the stock market. They find a different avenue. They invest in gold. They invest in other assets. What I'm telling you right now is stick with it. Continue to underwrite, but understand whatever markets you're in, know what's going on with the supply, with demand, with rent growth, and with the expenses in that market. I had a lot of doom and gloom in the first part. And doom and gloom, believe it or not, is actually pretty good. We just interviewed a gentleman named Kent Roars on the Jake and Gino podcast. It's launching in a couple of weeks. Just remember his name, Kent, Roers. Just go look at the Roers Group. He started in multifamily in building back in 2012. He built a 30 unit on his first deal. Now he's done 100 transactions since then. 2012, if we just go back in history, it wasn't that long ago. It was probably the worst time to start building. It really was. There was no capital. It was so hard to go out there to raise capital, to get some kind of desire. Jake and I started in 2011. It took us 18 months. We bought our first deal in 2013. It was terrible. Now looking back, pulling yourself out of the situation, and that's what I'd like for you to do right now. If you're in the market right now, you're in it. You're down, you're emotional, you've got all the energy and all the juices flowing right now, and you just can't see the light at the end of the tunnel. I'm here to tell you that right now is probably a pretty good time to start investing if you haven't. And if you are investing, to continue to talk to your investors, to continue to talk to brokers. Because right now there's the opportunity. When everyone's fleeing the exits, when people, see the building on fire and they're leaving the building, and that's what's going on with this economy. It's been that way for the last 18 months of stagnation. There's a lot of listings. If you're in residential real estate right now, there is a lot of listings. They keep talking about this oversupply. You have more people that want homes that are listed right now. It's incredible. They're saying that new home builds are actually cheaper than homes that are on the market right now. There's an imbalance right now. The affordability. We don't have a housing crisis. We have an affordability crisis. There's enough homes on the market right now. The problem is that the prices are too high, and this is just part of the market cycle. The market cycle is going to correct itself. It did back in 08 and 09 when prices were crazy. They dropped down. So right now, what you can do as an investor, as you're looking at all of this, if you've got a portfolio, focus on operations. That's what we've been doing for the last 6 months. We've only closed one deal this year. It was a 68 unit. It was a new build, 2024, an amazing property. But that's it. We've had one opportunity. We had a couple of other opportunities that fell by the wayside. One of the owners didn't want to sell because of tax consequences. Another owner wanted too much money. It didn't make sense for us. But what do? We decided let's focus on operations. We've got CapEx teams. We've actually have a decking crew going on. We have a siding team. We're working on the operations. And we're also learning about AI. How can AI actually help our property management company? If you're an asset manager or you're an investor and you have a database and you're a syndication company, AI can help you in so many different ways with outreach, with presentations, with decks, with helping with that customer journey with your investor. So if you're struggling with deal flow, there's always the other component, raising capital. Focus on that. And if you're an operator or an asset manager, focus on the operations of the properties. Make sure that you're maximizing rent, that you're limiting the vacancy, you're getting heads in beds that are paying. That's what we're doing right now. We're focusing on our operations, and it is coming back to us because there's a lot of CapEx projects. We have properties that are older that need tender loving care. So, hey, putting new decks on with our own team, going in there. A lot of our properties have water issues, a lot of roofs. We're putting in catch basins, catch drains. We're putting piping underground, getting water away from the building. We're repairing a lot of retaining walls. We're doing a lot of sidings on these buildings. It's really hard when you are in acquisition mode to be doing that as well. Because when you're acquiring assets, you're also turning those units. But right now we've had a lull, so we've been able to focus on that. Now, the second part, I would say, if you're an active investor, you're focusing on operations, just please, please, please stay patient. Short-term softness right now does not mean long-term weakness. It's part of the market cycle. Go back to what happened in 2012 and 2013. How many of you on here would have said to yourselves, man, I wish I got into the market back then, but I didn't? That's what's going on right now. It may take a little bit longer, but right now, get your ducks in a row. Right now, focus on what your business plan is. To us, it's buy right, it's finance right, and it's manage right. Right now, it's focusing on the vendors that you have. Do you have a strong finance team? Do you have contacts with community banks, with credit unions? Do you have any kind of DUS lenders that you know, right? The buy right. Are you focusing on creating relationships with the brokers? Are you talking to property management companies in the space? Are you also talking to other syndication companies? Are you going to events? Are you networking? These are all things that you need to do. You remember Kent Rohrs that I just mentioned in 2012? He spoke to every single person that would listen to him about investing in his multifamily project. He talked to friends. He talked to family members. He talked to coworkers. He was a certified financial planner, so he spoke to clients that he had. That's what you need to be doing right now. Now, looking ahead, there is opportunity. It is always, in my opinion, multifamily is a basic human need. There will always be people that want to rent an apartment. You can't buy it on the internet. AI is not taking this asset class away. The great thing about it is AI can amplify your returns. It can make your asset more valuable through the marketing, through the systems, through the processes. That's focusing on operations. So for us, long term, what I'd love for you to do is to focus on a couple of markets that you like, whether it's in your backyard, or whether it's a market that you think you can actually make money. Understand that. Invest for the long term. This is not an 18-month quick get rich kind of scenario. It's not 2020, 2021 where you're flipping assets. The market cycle has changed. Have a little patience. Have a long-term outlook. And I'm not talking patience next 10 years. It's a 3 to 5 year right now. If you're buying an asset right now, in the next 3 to 5 years, that asset can create an incredible amount of wealth. Now, to wrap this all up, we're seeing softening in rents. We're seeing vacancy drop. We're seeing more competition because supply is coming on. But at the same time, we're seeing those 600,000 units that were delivered last year and 243,000 had been delivered the first half of this year. That's starting to burn off. That's the positive number. Concessions are starting to burn off. So if you're serious about getting into multifamily or continuing the journey, just always focus on those two things: buying assets and focusing on raising capital. We want to thank you for spending part of your day with me. My name is Gino Barbaro, and I'll see you on next week's show. Thanks for tuning in. If you enjoyed today's video, be sure to like and subscribe so you'll never miss another episode.